Welcome to the Morrison Report. Hosted by Deval Morrison, sales representative for Bosley Real Estate Limited Brokerage. Ms. Morrison has co-authored the best-selling book, Success Today, with Brian Tracy, and has been interviewed on NBC, ABC, and CBS affiliates by Bob Guinea from The Bachelor. Deval, a real estate investor, has spoken to many attendees at her real estate seminars and is currently ranked in the top 5% of agents in her brokerage. Join me in welcoming your host, Deval Morrison.
Welcome to the Morrison Report. I really wanted to create a podcast that would give people insights into the Toronto real estate market. You can follow me on Twitter at Deval Morrison and on Instagram as Deval Morrison, and you can also like my business page on Facebook. On today's episode, we have Ben Sammut with us. He is a mortgage agent with Mortgage Architects. He is also a millennial. So today we're going to be talking about issues affecting millennials and their mortgages. So join me speaking with Ben. So Ben, tell us, what are some of the most important things for millennials to know and do about getting a mortgage?
Well, I think it first and foremost starts with the fact that we need to differentiate ourselves from the American market. Usually what happens is a lot of millennials are getting the news from, these dismal housing markets going on in the States and dismal job markets. And while the job market is a little different nowadays from what our parents had, mortgage financing is a bit of a different animal down there. So we don't need to be as discouraged. And I always start with just start with a plan. See where you are now.
Cool. Awesome. Yeah. That's great advice. So someone comes in to see you. What's the first thing that you take them through or you do with them?
So the process of pre-approval is pretty straightforward. It's the same with a mortgage broker that it would be with the banks, but sometimes a little bit more detailed. So we'll have a primary conversation just to go through their needs. We see what they want to do, see if their expectations are realistic. And then from there, we just try to find the perfect fit between their income, their debt ratios, what their credit can afford them, and then really what kind of options they can pull on from there. So if mom and dad are able to help, if there's anything like income suites that we can look at, and I'm sure we'll speak to that a little bit later on, but we really just want to make sure that all options are explored for them so that they're realistic when by the time they're ready to go out with you, they know what they're looking for.
So before they come and see you, would you suggest that they pull their credit history beforehand so they have an idea of where they stand, or is that something that you would do for them?
It's something that we do. One of the benefits of working with a broker is that we're able to only pull one bureau and then present that to all of our banks. So there's a common misconception that multiple pulls on your credit bureau can damage it pretty badly. It's true that if you pull a few bureaus for, let's say, a car loan, then a student loan, credit card, mortgage, things like that, it'll affect your credit score negatively. But if you're just checking in and you take one of those consumer reports that are offered free through certain websites, it doesn't hurt for you to know, but we'll be able to give you a much better analysis anyways. So you're really free to do either way, but we'll certainly make sure you know what's going on.
So what are things that you might want to suggest that millennials could do now to make sure that they have a good credit history before they come and see you?
One of the things that I would definitely advise against is applying for multiple credit cards. So I have plenty of friends my age and slightly older that would always get free newspaper subscriptions or boxes of cookies or Raptors tickets for signing up for a card that they never use. And they think because they never use it that it's never going to affect their credit score. But there is a portion of your score calculated based on the amount of credit you have available to you. And I think a lot of people don't realize that it's not good to have $10,000 in unsecured debt available that could cripple you at any moment if you're looking to apply. So I say the best thing to do is start off with one credit card, make sure you're keeping on time with your payments. And then from there, just establish a good repayment history. As brokers, we're able to tell you which are going to really help out your credit score, which ones not so much. So as long as you've got somebody who's somewhat financial savvy to advise you and tell you exactly which ways to move forward, the main concern is just that you are actually thinking of your credit score.
So what if you're the kind of person that doesn't want to have a credit card at all and you want to pay cash for everything? How's that going to affect their credit score?
Well, it really isn't. It's not going to do any damage to their credit score. But when they go to apply for, $250,000 in a mortgage, and they don't even have any repayment history on a $2,000 credit card, it's a little difficult for banks to learn to trust them. So you're almost better off taking on a little bit of debt and establishing a good payment history before you actually try to take on larger debts like car loans and mortgages. Because if you pay cash for everything, you're trying to establish a cash-only standard, and it's just not really possible in mortgage financing.
Yeah, I could see that. It's funny. When I went to university, I had all the credit card companies all over me. Hey, you're in university now, so apply for a credit card. And I did. But it's a good thing I did because I have them now. But I recently worked with a client who was looking just to get a rental. It wasn't even for a mortgage. And when we looked at his credit history, we realized it wasn't very high. And one of the reasons is he just believed in paying cash for everything. So I told him, you better go out and get yourself some credit cards. This cash thing doesn't work.
Yeah, it can sometimes do more harm than good.
Yeah, absolutely, for sure.
Mm-hmm.
So now what about millennials who are getting help from the bank of mom and dad or other family members for mortgages? Is there something that they should know about getting those kinds of gifts?
Yes. So actually the bank of mom and dad is a fairly new phrase. That actually only came out a few years ago as far as I know. But it's becoming so prominent now that I'd say probably about 40 to 50% of our buyers that are under 35 use funds from their parents today. So if money is coming from your immediate family, that's fine. The banks are perfectly okay with money coming from mom, dad, or siblings. But as soon as you start to extend beyond that, so if you're borrowing from aunts or uncles, family friends, or just friends, the banks don't really allow that because it's not close enough of a relationship. So they start to look at that as a personal loan. The only allowable gifts are from immediate family.
Interesting. So would you say that, do those gifts have to be in their bank account for a certain amount of time for them not to be considered a personal loan?
It's going to depend on the bank that we take them to. We work with about 60 different lenders. So each bank has their own rules and regulations behind that. Usually what we try to do is just establish that the money is in fact in the parent's account. So that way on the day of closing, they can just bring the funds to the lawyer and the lawyer will amalgamate all funds. Some banks will want to see the gift transferred to you either 15 or 30 days. And then under certain circumstances, so if you've got mom and dad living in the States or if they're living abroad, depending on where your parents are, they might want to see them anywhere between 30 or 90 days into your account.
Interesting. So, you had sort of alluded to this earlier where you said you're probably seeing around 40% or so of your millennials that you're working with are getting money from family help. I noticed there was a recent study in Canadian Business Magazine that said that 65% of millennials rely on family to help them get their down payment. But in your case, you've noticed your percentages are a little bit lower?
They're a little bit lower, but I think it's just the type of clientele that we work with. We tend to specifically focus within the downtown Toronto core and some parts of the GTA. But when you're looking at that data, Canada-wide, it's going to be a little different if you're comparing markets for, let's say, Sudbury or North Bay versus Windsor or other parts outside of the city.
Right.
But as an average, I think you will typically see higher just because property values are somewhat lower outside of Toronto.
Right. For now, anyways.
For now, yeah.
So for the millennials that aren't using help from family, what would you say? I guess a lot of those people are taking on some really large mortgages?
Relatively large. So usually when you've got first-time home buyers, particularly millennials, they're going to opt for a high loan to value. So with CMHC's rules, you can put as little as 5% down. That does change when you go over 500,000. So I think we'll speak to that a little bit later as well. But typically, most millennials are going to want to put as little down as possible, just because you had alluded in your first podcast about mortgage payments being considered forced savings. So about half of that payment is going to go towards your equity anyways.
Right.
So their first step is really just getting into the market. And the cheapest way to do that is put the 5% down.
So what are some of the largest mortgages that you've seen millennials taking on then in this market?
It really depends. When mom and dad get involved and they're willing to gift $200,000 or $300,000 or $400,000, there really is no limit in that regard. But if you're looking, your typical, let's say 30-year-old earns about $60,000 to $70,000 a year, and then mom and dad are helping out, their price range is usually around $450,000 to $500,000, and then whatever savings they can come up with themselves with their parents. Usually they're buying with between 5 and 10% down.
And so for the people who aren't getting help from their parents, what kind of mortgages would you say that those people are taking on?
Oh, right. Sorry. In that case, their mortgages are a little bit lower, but still around the same price range. We as a generation are surprisingly good at saving. The problem is that it's more intimidating to take that plunge, which is why you're seeing lower, I'd say lower participation from people that aren't using their parents.
Ah, gotcha. So then, for example, a lot of the houses in Toronto are really over $1 million. So do you see millennials buying some of those houses? Like once they sort of couple off, are some of those millennials buying those kinds of houses, or are those houses out of reach for most millennials?
I'd say very rarely do you see millennials buying detached or higher end semi-detached homes in the downtown core. Usually when you've got someone under 35, their price range is much lower than the $1 million, which automatically prices them out of there.
Yep.
So they're either looking at condos in the city or somewhere out of the core. They're looking at investment properties or sort of semi-detached.
Perfect. That makes sense. And then also in Canadian business, they had another stat about, they said about 40% of millennials are actually buying pre-construction homes, condos, those kinds of things. Is that something that you're noticing as well in your business?
It does happen a lot. We don't necessarily advise to go that route. There's nothing wrong with buying pre-construction per se. It's just when you've got millennials that have already come so far and they're able to buy now, what we find they're typically doing is just trying to get into the market as quickly as possible. So our clientele typically doesn't go for new construction as often, but I can definitely see the motivation there. I mean, we are the the new and shiny generation, so I can see why resale isn't as appealing to them. But we're also the instant gratification generation. So to wait a year and a half or 2 years for your condo, it's just not that appetizing.
Yeah, it's funny. And I was about to say, I've certainly noticed it with some of the millennial clients that I've worked with, that they do tend to want things now as opposed to starting small and building up. In my generation, it was, you know what, let me start off with something small that I can afford. And over time, over 20, 30, whatever years, I will take my time to move up in the market. But I do generally notice that a lot of millennials now, they want what's shiny and new, and they want it right now. They don't want to wait. So I think that's unfortunate, because I think there is something to be said for just taking your time, starting small and sort of building a base and gradually taking on more debt versus getting it all right now and making it shiny and new.
I completely agree. And another piece of advice when it comes to new builds as well is that if you are taking on that type of liability, we know in today's market with today's lending guidelines that you can afford to do this. But if you're banking on a year and a half or 2 years from now, if for whatever reason minimum down payments change or lending guidelines change, you do leave yourself a little bit exposed that for whatever reason you might not be able to qualify then, or it's just going to be that much more cost prohibitive.
Yeah, that makes sense. Absolutely, for sure. And I guess you can't really sort of tell, are those millennials sort of more urban focused or suburban focused?
I'd say when it comes to buying new build, they're almost always more urban focused. So we very rarely see millennials that are buying new build housing projects in sort of the suburbs. Those are typically for a slightly older generation, more developed families, I'd say. And the new build cohort is a very specific type of millennial buyer.
And who would you say that specific type of millennial buyer is then?
It's going to be the people that are more into the trendy neighborhoods. If I were to profile them, I'd say maybe somebody that was renting in the entertainment district or City Place or Liberty Village prior to that. Mm-hmm. It's the lifestyle they've more become accustomed to. And there's nothing wrong with that. It's just it's more the type of person you see. And
then what about the resale market in terms of millennials? Are you noticing that they are more urban versus suburban, or?
We actually kind of see a mix of everything. By the time millennials are willing to go into the resale market, whether it be a small condo or a single family home, it does take a little bit of modesty to go into a resale property. So by that point, it's more that they've been fully prepared for that. They're acknowledging that there's going to be maybe some ugly paint on the walls or something that needs to be changed with it, but they're making a wiser and more informed decision at that point.
And so on the resale front, if a millennial is buying one of those homes that needs a little bit of work, can they get some money from the bank to help them, like one of those purchase plus improvement mortgages? How are those with millennials?
They're actually quite popular. So the way the Purchase Plus program works is that it allows you to essentially gross up the value of the property a little bit and then borrow against that future value. So once you move in, if you need to change windows, doors, floors, anything like that, that's really just going to spruce up the place, we can include that in the mortgage financing. It does have its limitations, though. Some people hear about this program and they get very excited to blow out the back of the house or add a second story and do $500,000 in renovations. It doesn't quite work like that. It's more for minor renos. But if you're looking in a less competitive space, or if you're just looking to fix a little something here and there to make it more your home, it's a great program to use.
So could somebody renovate a kitchen or a bathroom using the Purchase Plus improvements?
Absolutely. The only thing that they're not allowed to do with that is any removable assets. So if you do renovate the kitchen, you wouldn't be able to include any of the stove, the fridge, or anything like that. No hot tubs or landscaping or anything. But for permanent fixtures and improvements that are genuinely going to improve the value of the property, it's absolutely allowed.
Cool. That's awesome. That's great. And then what about construction financing? Do millennials tend to take those kinds of things on, or that's for another generation?
Construction financing is a bit of a different animal. You're going to different parts of the bank at that point. They're usually assessed on an individual case-by-case basis, and the rates can be different. The lending fees can be different. So it's more taken on by people who are more seasoned in purchasing real estate and a little bit more ambitious. It depends on the scope of the work as well. So if you're just looking to blow out a bedroom bedroom and turn it into a bathroom, that could potentially fall under the purchase plus improvement program. But if you are planning to completely gut a house, take it down to brick and mortar, then that's more the construction financing end of things. And it's a very, very specific type of financing that people usually prepare for months in advance.
Got it. Yeah, that definitely makes a lot of sense for sure. And anything